Summertime to all you remarkable real estate professionals out there. School is out and peak home buying season is officially upon us. This is the Texas Real Estate and Finance Podcast, and I'm your host, Mike Mills, a North Texas mortgage banker with Geneva Financial. I'm here each week helping you sift through all the news impacting your business and hopefully bringing you some helpful insight along the way. But when I'm not pontificating on this podcast, I help your clients buy and refinance their homes. My team and I specialize in those not so easy situations. We have loans for all kinds of unique circumstances and are great at solving problems to help your clients get into the home of their dreams when others can't. So if you're having issues finding someone to help solve that out-of-the-box situation, give us a call. We'd be happy to help in any way we can. Okay, enough about me. What relevant real estate information is coming your way over the next 20 to 30 minutes? Well, in the leadoff spot, as always, mortgage interest rates. After a couple of strong weeks pushing rates to yearly lows, we're back over 7% again and creeping up the last few days. I'll tell you why and what to watch out for over the summer. I have some updated housing inventory data for the nation and right here in DFW. Inventory is increasing as we head into the summer buying season, so your buyer might have a little more selection than they've had in recent years. I've got some information on why home and auto insurance is so expensive these days and why having your client get their insurance quote during the option period or even before they execute the contract altogether might be a pretty good idea. That insurance premium could affect your client's ability to qualify for their home loan. I've got an update from the VA regarding the commission change rules that are coming in August. And finally, with Americans having more home equity than they've ever had before, but also historically high credit card debt at record-breaking interest rates, I'm going to arm you with all the ways that your clients could access their equity and even show you how sharing that information with them could lead to a past client selling their home with you and possibly even buying another one. So stick around to the end for that. But before we start, please help a mortgage lender moonlighting as a podcaster out and share this episode with a friend. If you know someone like yourself that might get some benefit from my weekly ramblings, please let them know. I love new listeners, and you guys are the key to making my podcast dreams come true. So like, subscribe, comment, and share. I'd greatly appreciate it. Okay, so what happened with rates last week? Well, after several bad days in the bond market because of some positive economic data, according to Mortgage News Daily, as of May 27th, the average 30-year fixed conventional mortgage is about 7.125%, and the average 30-year FHA is about 6.75%. The average 15-year conventional rate is about 6.75%, and the average jumbo rate is somewhere around 7.5%. Again, according to Mortgage News Daily. We're going to get Q1 GDP data on Thursday and April PCE inflation data on Friday. And both should have an impact on rates depending on the story they tell about our economy. You see, if GDP comes in below market expectations, you would expect the bond market to improve, lowering interest rates. But if the GDP comes in higher than expected, then we could see rates jump up a little bit. And if April's PCE inflation, which is the price that we pay for goods and services, comes in higher than expectations, then you'll definitely see rates snap higher. But if inflation comes in flat or even below expectations, then that would be some positive news for mortgage rates overall. You see, most people paying attention to all this economic data, at least as it pertains to mortgage rates, don't expect inflation to be the trigger that ultimately causes the Fed to start lowering the Fed funds rate. But instead, the deteriorating labor market is what, if anything, is expected to trigger the Fed to begin cutting rates. Remember, the Fed's dual mandate covers price stabilization, but also full employment. And right now, it's much more likely that we see the unemployment rate continue to increase before we see a significant drop in inflation. Because as it stands, unemployment is at 3.9% right now. And with the layoffs increasing every month here in 2024, especially in tech, manufacturing, and the finance sectors of the economy, it's very likely that we'll see that unemployment rate increase over the next several months. And if we hit 4.2%, that's the level where you could expect to start seeing discussions from the Fed regarding rate cuts. Because right now, inflation is being impacted heavily with the rising cost of insurance, energy, food, and housing, none of which raising or lowering interest rates is going to impact. CoreLogic report that single-family rentals are up 3.5% from this time last year, and attached or multifamily properties are actually down 0.6% for the first time in 16 years, which is good, but not enough to move the needle compared to the single-family rents. And oh, by the way, that's mostly due to the overbuilding of apartments, condos, and townhomes over the last 5 years. But that construction is all but stopped since rates turned upward. So you can expect those rents to climb over the next several years as that excess supply gets utilized. There is some good news on inflation though. Target says that it's dropping the prices of over 5,000 common items, joining a growing list of stores trying to draw inflation-wary shoppers. Target's list of price cuts posted on Monday includes milk, meat, bread, soda, fresh fruit and vegetables, snacks, yogurt, peanut butter, coffee, diapers, paper towels, pet food, and more. The company said that it's already lowered prices on about 1,500 items and will continue to do so throughout the summer. So cracks are starting to show in some of the middle to higher end retailers. Amazon and Walmart are still doing great, but that's because consumers will continue to buy necessities, but will just trade down to cheaper retailers as their discretionary income continues to be impacted. So if you want lower rates, we need lower inflation and or higher unemployment. And until that happens, we're going to be living in this 7% range for the foreseeable future. Okay, now let's look at last week's housing trends to see where the overall market is headed right now. So this past week, we actually saw inventory grow by 16,500 overall available listings. This is great news for home affordability and sales because we did not see this hardly at all last year. The weekly inventory change rose from 578,000 listings to over 594,000 listings. And this same week last year, inventory rose from 424,000 listings to 433,000 listings, only about a 9,000 listing change. And this week is the inventory peak for 2024 at 594,000 listings. We're trending at about 37% more listings on the market compared to this same time last year. Now, we still are not at pre-pandemic levels, which saw close to 890,000 listings on the market in 2019 at this exact same time. But another good sign for home prices and affordability is the percentage of homes taking price cuts. In 2022, at this time, 23% of homes were taking price cuts. In 2023, at this time, 30% of homes were taking price cuts. But already in 2024, that number's jumped to 35% of the homes on the market right now are taking price cuts. So that's good for overall affordability. Now, purchase applications are a whole other story. There does tend to be a decline as we get out of May and into the summer, which is normal seasonality. And last week further proved that point. Purchase apps fell 1% week over week, and they're down 11% from this same time last year. And this is a continual trend so far in 2024, because so far this year, we've only had 6 weeks of positive application data compared to last year, where we've had 11 negative weeks of application data compared to last year. Also, another reason we might start to see inventory improve at least some over the next decade or so, unless builders pull back on production, of course, is the U.S. Census Bureau keeps downgrading the expectations for the U.S. population over the next several years. So, some great reporting from Lance Lambert of Resi Club, who I often use to find great data for this. Check him out on Twitter. According to a recent article from Lance, the U.S. Census Bureau has downgraded the expected population numbers for the U.S. by 2050 again. You see, in 2008, it was forecasted that by 2050, the U.S. population would reach about 439 million people. Then in 2012, it revised its forecast down to 400 million by 2050. And in 2023, it was revised down again to 361 million people. That's over 78 million people less in the U.S. than was expected in 2008. And by 2038, the U.S. Census Bureau expects U.S. deaths to start exceeding U.S. native births. And in 2081, they expect the total population to actually begin declining. And really, this is mostly due to people just not having children. Now, does this impact housing today? No. But over the course of the next 15 or 20 years, it's going to have a significant impact on housing, inventory, and affordability. Hopefully for the positive, because there's less people for the same amount of homes. But if construction stays stagnant, then it may not impact it at all. But this lowered population is also going to have impacts all throughout the economy. And as Lance correctly points out in his article, this might be one of the biggest long-term stories in America right now. And it's also affecting everyone all over the world. Some really crazy times we live in. Now, those are some national housing numbers. But what about right here in good old Dallas-Fort Worth? Well, the Dallas Morning News reported last week that DFW ranks second in the nation for homes sold and active home listings just last month, trailing only New York. We had nearly 8,500 transactions that were closed in April, up from the 7,800 the previous year. There were more than 13,000 active listings and almost 31% year-over-year jump, according to data from RE/MAX. The report also found that active housing inventory is up by 49% year over year, but home prices are still up 1.5% annually. And right now, the median home price in DFW is about $405,000. DFW had 3.2 months of housing inventory in April, at least according to MetroTech's data. And that's near pre-COVID levels. But a 6-month housing supply is something that we consider to be balanced. So inventory is up, but still not close to what we had just 10 years ago, which is why with even higher inventory, home prices are still going up. And also, some of that 3.2 months of inventory includes new construction that isn't completed yet, meaning it's not ready to move in, keeping future home buyers from listing a possible house that they would sell, keeping inventory down as well. but it's still improving nonetheless, which is good for buyers looking to get better deals on homes that are currently available right now. It just depends on where you're looking. There's some areas in Dallas Fort Worth that have a glut of inventory, and there's some that still barely have enough to have any choices. Because as we all know, real estate's different state to state, city to city, and neighborhood to neighborhood. But more inventory is always good for affordability. And as long as rates stay elevated, we should expect to see this trend continue. All right, let's talk about a very exciting topic, which is homeowners insurance. Now, if you own your home, or heck, even if you own a car at this point, you know that insurance rates have gone through the roof, no pun intended, at least over the last couple of years, all across the country. Now, I did an entire episode about this back in January of this year. I had a good friend of mine, Brad Bingham with Allstate, on the podcast, and we discussed many of the reasons for these big jumps in premiums. So check that episode out if you want to go a little deeper into this subject. But here are the top 5 states with the highest home insurance rates for a $300,000 residence, according to Bankrate. Florida's number 1 with $5,770 per year on average. Louisiana is number 2 with $5,710. Obviously, lots of flooding and weather in those states. Mississippi is about $4,300 a year. Again, on the coast, lots of weather. Texas right now is sitting at about $4,000 a year. And Alabama comes in 5th at $2,900. So right here in the Lone Star State, we're sitting at number 4 in highest insurance premiums across the country. And just to give you a little context, according to a 2019 report by the National Association of Insurance Commissioners, the average annual premium for homeowners insurance in Texas was just under $2,000. So that's over a 100% increase in just under 5 years. So why is this? Well, the primary reason for inflating insurance prices is the increasing number of claims in recent years. The payouts connected to these claims mean that insurance companies are increasing prices to offset their costs. Government data shows that 2023 was a record-breaking year for damaging weather and climate events. In fact, in 2023, there were 28 such weather events that were recorded, each totaling at least 1 billion of damages, which substantially exceeds the previous high of 22 events set in the year of 2020, and double that of 2019, which only had 14 of these said events. Now, some of this is due to there being more weather events recently, but also that these weather events cost so much more to pay for repairs because of the cost of goods and inflation. And aside from this affecting your pocketbook personally, you need to make your clients aware of this, especially first-time homebuyers. I personally know of insurance companies denying people over low credit scores, claims that they've made on their properties in the past, and even claims made on the property that they're trying to purchase, which is unheard of, at least in my experience. So getting a quote on insurance needs to be something that they either do right away during the option period once the contract is executed, or even before they execute the contract. As a lender, I've personally changed how I estimate insurance premiums for buyers over the last couple of years. But even when I raised my expected premium from $200 a month to $250 or $275 on, say, a $300,000 home, there have been circumstances where they're coming back at $350 or $400 a month, depending on the buyer. And if someone's debt to income ratio is tight, then this extra premium could cause them not to qualify for the loan, or at least make that payment so much more expensive that they don't feel comfortable with it anymore. And this is becoming more and more of an issue. And with higher rates and higher home prices, this is just one extra piece that's making these mortgage payments more and more unaffordable with all these factors. So my advice to you is to start making this part of the expectation setting with your buyers, because this is becoming more and more of an issue. And if your lender or the lender that the buyer is using doesn't address this up front, it could be a deal killer. So watch out. Now, something as an industry that we knew was going to need to happen is finally working its way through the system right now. As many of you may or may not know, the VA, as of right now, does not allow for the veteran to pay a realtor commission. It's one of the unallowables. So when August 17th hits, if a VA buyer finds a property where the seller is unwilling to pay the agent commission, then as it stands right now, that agent on the buy side cannot get compensated because the VA buyer cannot pay. So that puts VA buyers at a significant disadvantage in finding a home, or even just offering on homes with a reputable agent once these changes take place. But we got some good news on this front. Last week, VA officials announced that a temporary fix would be issued before June 12th of 2024, and that a formal policy change was expected to follow. One possibility is that real estate commissions could become an allowable fee for VA buyers, giving them the same flexibility as other buyers. They did this recently with pest inspections. Pest inspections used to be a non-allowable, but now the VA buyer can pay their pest inspection in order to keep their offer competitive with conventional and FHA buyers. Although they still have not said specifically what exactly they are going to do for sure, they are hinting at the changes. And at least at this point, They're saying that something is coming, giving veterans a sense of relief to know that there is at least a plan. Look, we all knew this was going to be an issue, and really it was just a matter of time before the VA decided to fix it, and now it looks like they are. But stay tuned for updates on this as we get them. Finally, here's something as a realtor, it may seem like wouldn't be as important to your business at first, but having knowledge about this could be a secret hack to help you get more clients. And that secret hack is something we call equity loans. So right now, according to the February 2024 ICE Mortgage Monitor report, the average homeowner currently has about $299,000 in home equity, of which about $193,000 is what we call tappable home equity. Also at the same time, the US credit card debt is sitting at close to $1.1 trillion. This is at all-time highs. And the average rate on this credit card debt is also at an all-time high of about 28% interest, at least according to Forbes. This is such a problem that Freddie Mac recently announced last month that they have plans to get into equity loans themselves, which they never have before. The FHFA announced a request for comment on a proposal to allow the government-sponsored enterprise to purchase single-family, closed-end second mortgages when it owns the risk of the corresponding first lien mortgage, subject to a combined loan-to-value ratio of 80%. If the home equity product is approved as proposed, it would have terms of up to 20 years, be manually underwritten, and remain in Freddie's portfolio for 6 to 9 months until the creation of a second mortgage non-TBA guaranteed security. During that time, however, borrowers would be unable to refinance their first mortgage until the product is paid off, unless it's prohibited by law. This just means that Freddie Mac is trying to give a second mortgage as long as they are the insurer of the first mortgage and the combined loans do not exceed 80%. And a closed-end mortgage just means you can only access it one time. Until there's a secondary market created for these mortgages, your buyer would not be able to refinance their first mortgage until that second one was paid off. But often you can combine the two of them together into one mortgage later on. So how does this information help you? Well, this is a reason to reach out to your database of past clients because many of the people that you've worked with in the past are going through these debt issues right. And as their forever real estate expert, your job is to offer solutions to them as it relates to real estate. And this is one solution that could help a ton of people. So what type of equity loans are available? Well, you have a home equity second lien. This is the same type of loan that Freddie Mac is trying to start insuring, but it already exists. However, you can only get it with small independent banks. So a home equity loan, also known as a second mortgage, lets you tap into your home's equity with a lump sum loan. These loans are secured by your home as collateral and typically come with fixed interest rates and minimum payments that you'll make over the term of the loan. And thanks to the fixed rate nature of these equity loans, they can be a smart choice if you know how much money you need and want consistent monthly payments, and if you don't want to touch your current low rate on the primary mortgage. However, these days, this type of loan is much less available on the market because of banks tightening up lending standards. And the rates on these could go as high as anywhere between 11 to 15%. It's still better than 28% credit card rates, but with few options out there and the requirements being pretty strict to qualify, this isn't a loan that's available to everyone, which is part of the reason Freddie Mac is looking to get it into the market. Now, the next kind of equity loan is what we call a HELOC, a home equity line of credit. A HELOC allows you to borrow from your home's equity with a line of credit. Now, this starts with a draw period in which you can borrow against the home equity as needed, up to your credit limit. And in most cases, you're only required to make interest payments during that draw period, which typically lasts about 5 years. Now, following the draw period, the repayment period begins, which is when you make payments towards interest and principal. Now, HELOCs typically come with variable interest rates, which could be beneficial right now as experts expect interest rates to start falling later this year and into next. And if rates decline over time, then the rate on your HELOC would likely follow suit, meaning you'd pay less in interest on the money that you borrow. HELOCs also give you a lot of flexibility on borrowing, which could come in handy if you don't know how much money you need. On the other hand, though, if interest rates go up in the long run, your HELOC will likely follow suit. So you could end up paying more interest than you would with a fixed rate home equity loan. But again, the requirements on these loans can be pretty high. You're limited to how much equity you can tap using these products, and less lenders are offering them right now. So it might not be the best option for all borrowers. And lastly, you have what's called a full cash out refinance. So with this type of loan, you refinance the entire mortgage on your home and borrow money from the equity in the process, having one lump sum loan. So unlike a home equity loan or a HELOC, a cash out refinances replaces your current mortgage with a new mortgage loan at a new rate and new terms. Now, this could be a tough sell for someone sitting at 2 to 3% interest on their current loan, but surprisingly, there are still lots of people out there with 4 to 5% interest on their current mortgage. And 7% is higher, of course, but 28% credit card debt interest is ridiculous. And also, the requirements on these loans are a little bit easier to qualify for because they're guaranteed by Fannie Mae and Freddie Mac right now. And you can typically tap more equity than you could with a HELOC or a second lien. So it may not be right for everyone right now, but it might be very helpful depending on the situation, especially if people have monthly credit card or other debt obligations that far exceed what it would cost to consolidate those all into one loan, saving money in cash flow on a monthly basis. So the real question is how is this going to help you sell more homes? Well, number one, this is an excuse for you to contact your database and let them know what's going on with their equity and give them an option to a solution to possible credit card debt. You're just letting them know how much their home is worth and how much equity they have. It's just another touch point to put you in the role as the expert in all things real estate. Not to mention that when they know how much equity they may have sitting in their home, it might spark the idea to try and sell it, causing them to pick up the phone and call you with more questions. And if they do decide to sell, then they may also want to buy. And you know what? Even if they don't want to do either of those things, it's just another reminder that you're the realtor that's always looking out for their best interests and that you have solutions to any issues that they may have or that one of their friends or family may have, because your client has a network too. And if you're their go-to expert giving them ideas on how to solve a problem, they may share those ideas with their friends and family. And that's never a bad thing. We all need future clients as well. So, are you helping your clients in all things related to real estate, or are you just waiting for the phone to ring? Well, that's all for today, guys. Rates are still elevated, inventory's growing, insurance is expensive, VA's fixing their commission issue, and equity loans could help you find more buyers and sellers. I really hope you got some valuable real estate nuggets today, and I hope to see you back next week. Join me on Thursday as I welcome Jeff Zempfer to the podcast. Jeff is a digital marketing expert in the real estate space, and he's coming here to share all his tricks and knowledge with us on how to use digital marketing to grow your business in 2024. So tune in for a masterclass in real estate marketing. Thanks for hanging out with me, guys. I hope you all had a safe Memorial Day weekend, and until next time, be great humans and keep grinding, because life is what you make it. So make it great. See you later.